Hi, good morning, everyone. Thank you for joining us today for this webinar here with Sage Group. We have Marissa here on the line with us. I'll go ahead and quickly go over some house rules and then make an introduction for our office as well as their organization. And then we'll go ahead and let her take it away with her presentation. Of course, I'm sure you guys have a bunch of questions that you're wanting to ask as well. So we'll go ahead and jump right into it. My name is Randall Fink here. I'm the head of investment here at the Israeli Economic Mission here in San Francisco. We have 45 offices globally, 4 in the US. The San Francisco office is focused, of course, here on the West Coast, but we do have offices in New York, Houston, and Washington, DC as well. Our role is to connect Israeli companies to foreign markets, which is why we're located in the largest cities around the globe. We work with different corporates, different investors, and a bunch of strategic partners in order to assist their goals as well as Israeli companies' goals. Because ultimately what we're trying to do is get your companies in front of them and establish meetings and really just create a better sense of engagement between the different communities and ecosystems of Israel and all these large cities around the globe. So what we're focused on is getting that attraction and investment to the market of Israel and creating business specifically here on the West Coast, especially here in Silicon Valley and San Francisco. We're involved in a bunch of delegations where we bring companies from the Bay Area to Israel during non-COVID times, of course. And we do that across every sector that you can think of. So of course, it could be relevant for you guys as well. Our advantage is our warm network that we have. We've been around for many, many years. So we have many people in very large organizations, including corporates and investors. So it could be very advantageous for you to reach out to us where we can assist you in that manner. If you have any questions relating to this organization, please feel free to message me. I'll give you my information later as well. But of course, what we'll do right now is introduce Marissa. So Marissa is a VP at the Sage Group. She plays a key role in the firm's branded apparel and accessories, beauty and personal care, and e-commerce practices. Some of her past transactions includes the sales of Aribe, Pura Vitae, Blenders Eyewear, GLD, Mackage, BH Cosmetics, and many more. She continues to be very engaged in the broader finance community. She's an active member of the Milken Institute's Young Leaders Circle, and she co-founded Ladies in Finance, a leadership group of over 300 women working in financial roles throughout Los Angeles. As part of their Women's Leadership Awards, the Los Angeles Business Journal recognized her as a Next Gen Woman of the Year this year in 2021, and as a Rising Star in 2020. Marissa was also honored by Orly Beauty as part of their Women's History Month initiative back in 2019. She graduated cum laude from Columbia University with a BA in economics from Columbia College and a special concentration in business management from Columbia Business School. So Sage was founded back in 2000, which is an independent investment bank focused on providing M&A advisory and strategic guidance to high growth premium consumer brands and digitally native companies in the US and abroad. They have offices in Los Angeles and New York, and they work closely with founder entrepreneurs, management teams, and their investment partners on navigating transactions to maximize value and achieve shareholder objectives. With that, I'll go ahead and pass it over to Marissa to do a larger introduction of herself and also to go ahead and jump right in.
Hi, thank you. It's so nice to be here. Thanks to everyone for joining. I think my introduction was covered, but so happy to be here, and I'll just jump right into the presentation, and then we'll have some time for questions at the end. So let me share my screen. Can everyone see? Okay, I guess someone will let me know if you can't see. So I think the first slide was covered. So Sage is a boutique investment bank, which means we provide M&A and transaction services to branded consumer companies looking to achieve either significant minority or majority sales or 100% sales to both private equity firms and public companies. Sage focuses on the branded consumer sector. So we like to think of the fact that we have really three main verticals: apparel and fashion, and accessories, beauty and personal care, and then e-commerce and digitally native brands. So those three main verticals. Obviously, a lot of the e-commerce and digitally native brands overlap with the first two, fashion and accessories and beauty and personal care, but there are some instances in which they don't overlap. So if you think of like home goods or something like that. So really we work with brands when they're ready for a pivotal transaction. We say that we work with brands in the middle market. Most of the time, the middle market can be a pretty broad range, anywhere from 50 million to $1 billion in valuation. I would say our sweet spot is around $200 million. So when we work with brands, they work with us when they're ready to do one of those more significant sales. And we'll work with them to create really kind of leading materials. We create both kind of a marketing document that's called a SIM and a 5-year growth plan. And their growth plan really articulates the company's most important KPIs and also really establishes the growth of the business and tells that story in the best way possible. So all of our experience working with all of these brands, we really understand how each different type of business grows, whether you're growing through e-commerce, retail, wholesale, or a combination of all of the three. We have offices in LA and New York. And as was mentioned before, we were founded in 2000. I'm actually based in our LA office. All of the marketing directors and partners are involved in each of the deals. So you have very, very strong senior level attention. And it's been quite an exciting time in M&A over the past year, as I'm sure many of you know. I think it's probably obvious, but all the brands here are some of the brands that we've worked with over the years. So I know you wanted to have some case studies as well. So I brought 2 case studies just to explain a little bit more about what we do. So the first case study is the sale of GLD to HIG Growth Partners. And GLD is a rapidly growing digitally native brand that connects with a very diverse youthful audience. Their core products were, and the company still exists, are men's jewelry, mostly costume jewelry. So if you would imagine jewelry that kind of inspired by like what rappers or a lot of athletes wear a lot of the time, kind of the chains, the pendants, lots of bling, that's GLD. They had really key partnerships with the NBA, Marvel, MLB, NFL, and other leading sports teams. And they also were very much celebrated by key influencers like Wiz Khalifa and Justin Bieber, Cardi B, and many, many others as well. Their cult following was truly impressive. They had people loved the brand so much that some customers even tattooed the brand name on their body. And this happened so often that the company actually created like a Tattoo Tuesday initiative that kind of entered customers into a sort of raffle to win other prizes. So the company was growing rapidly. It was quite profitable. And when they felt like they were really at an inflection point, they engaged Sage to explore transaction alternatives. One of the important things about this transaction is that we were engaged and closed the transaction all during COVID. So COVID, although in some industries was very disruptive in a negative way, in our industry, especially for a lot of these digitally native brands, COVID really accelerated a lot of businesses, and the businesses that did exceptionally well were the ones who were able to leverage the low customer acquisition cost and acquire a significant amount of customers. And then this year and the years ahead, really continue to generate repeat orders from those customers as well. So instead of having what some investors call like a COVID pop, they actually just accelerated the business's growth during COVID and continued on an upwards momentum. We ran a very competitive and successful process and ultimately selected HIG Growth Partners, who invested a minority stake. HIG is a private equity firm, and their growth partners, their growth division is kind of their division of the fund that invests in growing brands. And the CEO and co-founder continue to run the business with strategic insight from HIG. So that's kind of one example. Another example is a case study of Blender's eyewear to Safilo. And Blender's is another direct-to-consumer business. They focus on sunglasses. And it was founded by Chase, who was a native Southern Californian and competitive surfer. And he actually started selling the business, or he started the business by selling sunglasses out of his backpack. It was completely bootstrapped, no investors throughout the company's trajectory until this transaction. And it really disrupted the eyewear with a branded option that was more affordable while still getting very high margins and impressive profitability. So we were engaged, this deal was about 2 years ago, but we were engaged in mid-2019 to explore options. And we prepared all the materials and we're prepared to go to market and talk to public companies and private equity firms like usual. But then when we had contacted Safilo, which is a public company based in Italy, they're the second largest eyewear company aside from Luxottica. It was extremely interesting to them. They wanted to preempt the process. And so we ultimately ended up only talking to one buyer. And from the first meeting to signing the letter of intent, it was about a month. So it was extremely accelerated process, and we're able to kind of harness all of the perfect timing of a lot of different dynamics. And ultimately, Safilo purchased 70% of the company in December 2019, and the remaining 30% will be acquired over time. So it was kind of like Chase, who's the founder, got the benefit of both the public company support and kind of the nice sense of feeling like you found your company a home, while also being able to partake in significant upside of the business going forward. So in this case, I just gave two examples of two different types of investors. One is private equity and one was strategic, but I want to take a step back and kind of talk about all the different types of investors. So the first type of investor is venture capital. They invest early stage in the business, and most of the time they acquire minority stakes. So that would be less than 50%. They make both primary and secondary investments. So primary means money goes into the business, and secondary means money goes into the shareholders' pockets. Growth equity is kind of early to mid stage. They will take a larger minority stake. Oftentimes with venture capital, there are multiple venture capital investors in a particular round. Sometimes with growth equity, there might be a couple, but it also could just be one investor. They'll take a larger minority stake. And again, most of the time money is going into the business, but there are options in which money can also go to the shareholders as well. Private equity is typically more like mid to later stage. At this point, most businesses are expected to be profitable, but the dynamics really depend on different types of business sectors. In terms of private equity, they'll acquire majority, 100%, or a significant minority. So when I say significant minority, often it's more like 20 to 40%, not like 5-10%. Naturally, like all of these kind of trends are very generalized, so every situation is different, but these are kind of the typical ways that these types of groups invest. And strategic means it's an independent company or a public company. A lot of times strategic investors are public companies because those are the companies that have the opportunity and the cash flow to acquire business, but it doesn't have to be public. Usually it's mid to later stage, and typically 100% of a business is acquired, unless in the case of blenders, maybe a certain percentage is acquired at one stage, and then there's a plan to acquire the remaining equity over time. So when you're thinking of going to market, there are different things that you should think about. One is timing. So you really want to understand the company's scale and size, and also you want to understand what the shareholders' goals are. So it might not be, you might know that there's a lot of growth on the table for the future, but maybe you really need a partner to achieve that growth. Or maybe you just really want to get money in your pocket because you want to pay for your kids' college, or you want to buy a house, or there's something else going on in your personal life. The company's size and performance. Often companies that attract investors are the ones that have demonstrated continued revenue and strong profitability, while also leaving some exciting near-term growth opportunities. So it's important not to kind of try to do a transaction once you feel like you've already done all the growth that the business has. And you really want to make sure that when you do a transaction, your business is still kind of on an upwards momentum versus plateauing. And also what the shareholder goals are. So understanding if you want to do a majority or minority, if you want to be involved with the business going forward, all of those things are very important. So sometimes when we're in meetings with clients and they're wondering if it's the right time to pursue a transaction, we usually say, you want to go to market when it's the right time for the business, when it's the right time for you personally, and when it's the right time for the market. And you can't time all of those things perfectly, but you kind of want to have a good sense that all of those three are kind of heading in the right direction. So based on your different ideas of the timing considerations, you can decide if you want to pursue more of a capital raise or minority sale, a majority sale, which means greater than 50%, or 100% sale. There's definitely pros and cons for each type of sale. And I would say a lot of them aren't necessarily like true pros and true cons, but really depends on what you're looking for. So for a capital raise or a minority sale, you get more near-term liquidity and there's significant upside from a second sale, right? Because you still own a significant portion of the business. Most of the time, when you only sell a minority stake in your business, you retain legal, economic, and operating control, although some investors might have certain minority rights. This is a specific pool of buyers, so the pool of buyers might be a little bit more limited depending on the size of the transaction. For a majority sale, there are significant proceeds to the seller, especially if profitability is strong and a buyer is also using some leverage to fund the acquisition. It still allows for future upside participation. So even though you might own 10 or 20 or 30% of the business versus 70, you might own a smaller percentage of a larger pie, right? So that could actually have significantly higher returns in the future. And then also naturally 100% sale, you get the most cash consideration upfront. You don't have any future economic risk, but you also don't participate in the business's future growth unless you have structured an earnout. And again, there's a more limited universe of buyers if you want to sell 100% of your business. That's mostly then going to be selling to a strategic, unless there's a private equity firm that currently has a company in its portfolio that's looking to acquire. Most of the time, private equity firms, if they're making like a standalone investment, they don't want to acquire 100% of a business because they want to make sure that the management team is incentivized to keep the business performing going forward. So we kind of covered a lot of these, but just to summarize a little bit more, in terms of a minority transaction, again, you get near-term liquidity and significant upside potential in the future. You also would have the opportunity to add more senior level board members and executives with expertise in the sector. So a lot of times an investor, not only will they provide funding, but they'll also provide a board seat and strategic guidance to help the business get to the next level of growth. And with an investor, you could also facilitate more sophisticated infrastructure and support to execute those growth opportunities. So aside from money and strategic guidance, they also have a lot of connections to other companies in their portfolios. You really can get a sense of how those businesses have scaled over the years. Again, there's relatively little liquidity up front. Investors might require more restrictive covenants, and they might have veto rights over major decisions, but all of this will be negotiated in the discussions. It might limit the pool of buyers who make minority investments, either because most buyers desire control or because they prefer to write a larger equity check. A lot of times buyers' size of the equity checks are dictated by the size of their funds and the number of companies they strategically want to invest in. So some might want to invest in a lot of companies and deploy a small amount of money per investment, and others really like to focus on kind of 5 to 10 core investments. And so if their fund is large, then their checks also have to be quite large. Kind of typically in the econ world, if you were to be in school for a minority transaction, we used to learn that the valuation could be discounted for lack of control. And there was a control premium when valuing businesses. Now, because businesses are so kind of high value assets are so sought after, and investors are excited to take to have the opportunity to have a stake in the business, there are some times when there's actually a higher valuation put on the business when there's a minority sale. And then oftentimes in minority transactions, you also have to make sure you understand the terms. So is it common versus preferred? Is there a coupon? Are there any liquidation preferences, et cetera? For majority transaction, significant cash upfront today, you typically allows the owner to retain substantial operational control as long as the performance is strong. So even if you sell over 50% of your business, if the business is performing, a lot of times an investor doesn't want to mess up something that's good, and they don't want to get in your way. The new partner would be highly motivated to facilitate future growth and liquidity. So you really have a strong, almost like a new team member, but again, most of the time they only get as involved as you want and as a business required. And a lot of the considerations are similar to a minority transaction, but it's probably more likely that debt would be put on the business in a majority transaction than in a minority transaction. And in this case, the seller would have to be more cautious of the minority rights, as the minority rights would be the seller's minority rights, not the buyer's minority rights. Then there's 100% sale, which again, this is to a strategic buyer, not always a public company, but often public companies. There's kind of two different ways to structure 100% sale. One is kind of a pure 100% sale, no earnout. So 100% of the business is acquired, you hand it over, and that's kind of it. Maybe you're employed by the business going forward. Maybe there's some sort of bonus structured, but you, as the seller, you would own 0% of your business. And theoretically, sometimes there's a higher valuation because of potential synergies with the buyer. But there could also be a lower valuation depending on the performance of the business because the buyer is accepting all future risk. In earnout, if you do 100% sale, but there's an earnout, it means like there's kind of a structured way to continue to benefit from the business's future growth. And this can also bridge valuation gaps. So let's say you think you have very strong, forecast for the remainder of the year, but you're selling the business maybe in March. So maybe a buyer will value the business as it is today and say, if your business achieves what you think it's going to achieve over the next 9 months, then we will pay you for that difference in valuation based on what you ultimately achieve for the full year. So earnouts can be structured all different ways. Some are, over just within the year. Some are earnouts over a period of like 3, 4, and 5 years after the close of the transaction. It really depends. But one of the biggest things to focus on when you're doing an earnout is really to make sure that the valuation at whatever time the earnout is going to be achieved is kind of very tightly negotiated. So you know exactly how the business is going to be evaluated. You know if it's going to be evaluated off of sales or EBITDA. If EBITDA, then you want to make sure the business is calculating EBITDA the same way you're calculating it at the time of sale. If the current owners decide to blast marketing because of a new initiative during a period in which you're going to be valuing the business for an earnout, then you want to know at the time of close that any kind of out of the ordinary expenses, whether it's marketing or, legal fees or accounting or something, will not be part of the calculation of EBITDA for the purposes of your earnout. So that's something that you would really negotiate with your lawyers and investment bankers. So now, we've been talking a lot about valuation. I'm sure a lot of you have heard valuation. I'm sure a lot of you understand what that means already, but just kind of wanted to take a step back and talk about what it is. So essentially, a valuation means enterprise value, which is a simple way to assess a business's total value. The formal definition is that it's an economic measure reflecting the market value of business. I'm sure I call it kind of like the cocktail chatter, but I'm sure a lot of you are at various events over time. And, there's a lot of jargon that's getting thrown around. And, sometimes you're like, well, my business is better than my friend's business, and my friend's business was valued at this, so mine should be higher. But really, it's kind of an art and a science. The science of it is that the enterprise value equals the equity value plus debt minus cash. And if you're a public company, then the equity value equals the market value per share times the total shares outstanding. If you're a public company, it's easy to calculate. You can also calculate the equity value if you're a private company, but sometimes it's a little more complicated. And especially at early stages of businesses. For transactions, the enterprise value is usually discussed in terms of multiples of revenue, which is net sales and EBITDA. So this allows people to compare valuations of companies of different sizes on more of an apples to apples basis. So the revenue multiple is the enterprise value divided by the company's revenue, and the EBITDA multiple is the enterprise value divided by the company's EBITDA. A lot of times, this is also quite subjective because a company could be valued off of the revenue that they're projecting for the full year, or the EBITDA they're projecting for the full year, or the revenue or EBITDA that they achieved over the last 12 months. So in order to get the highest valuation as long as the business is growing, you're always guiding investors towards forward revenue and EBITDA multiples. Investors, if they want to be more conservative, they're looking at more like trailing 12 months revenue and EBITDA. So some questions that might be coming to your mind as you kind of think about valuation is, do I get to choose if an investor values my business using a revenue or EBITDA multiple? And what if a business isn't profitable? It's not really that you get to choose whether a business is valued off of revenue or EBITDA. Naturally, if a business isn't profitable, then you're kind of default looking towards a revenue multiple. Most of the time, if businesses are profitable, they're valued off of an EBITDA multiple. A lot of times investors, very seasoned investors, will kind of have a gut sense of where businesses should be valued at, and then they'll kind of see how that falls out in terms of a revenue multiple and an EBITDA multiple. There's also kind of a lot of analyses that investors will do to see kind of where companies are trading in the market. So they'll look at revenue and EBITDA multiples for public companies, as well as relevant transaction comps in the space. So, and then related to what I was saying before is there a way to convince an investor to use projections versus historical numbers? The best way to guide an investor to use projections is to show that you have extremely high confidence in what the projections are going to be. If you're a wholesale business, then you usually have orders in advance. So you can guide investors to the orders that you've already received and say that you've already purchased inventory for these wholesale orders, and you're going to be selling these orders over the next 9 months. A lot of the business has changed over the years, and wholesale isn't as large of a component of businesses at this point. Naturally, if you have a subscription business and you can evaluate cohorts and churn rates of your subscription, that's a pretty clear idea of how sales are going to go over the next few months. And then otherwise, if you're more of a pure play e-commerce business, the best thing that you can do is look at your customer repeat rates and analyze your cohort data and see kind of how your customer orders are trending over time, how often they repeat, and at what average order value they repeat. And if you can kind of do those calculations and really extrapolate how your customers are going to be behaving, then it gives investors a strong confidence in your full year projections. Of course, a lot of direct-to-consumer businesses are also very much back-end weighted, meaning they derive a significant amount of their revenue and profitability in the last quarter of the year because of Black Friday, Cyber Monday, and other holiday sales. So to the extent that that's a large part of your business, it's really important to show kind of the seasonality of your business in the past and how your business plans to perform in any period that investors haven't seen yet. And as I was saying before, if it's going to be difficult to convince an investor to pay you off of forward revenues or EBITDA, then you can also kind of structure an earnout and say, if I achieve what I think I'm going to achieve by the end of the year, then I want to be paid for it. And just because you ask doesn't mean you get, but these are all different types of things that are kind of on the table to be discussed. So another question that might be going through your mind is, what is a good revenue or EBITDA multiple? And that really depends on the industry that you're in and the market at the time, as well as your business. I would say in a lot of the businesses that we work with, sometimes there's very high revenue and EBITDA multiples. And the companies that are getting the highest multiples kind of have a few key criteria. One, they're an extremely strong brand with what we like to call cult following. Two, they're an industry disruptor, so they're providing products or formulations or designs that are really unique to the market and are different than what customers can find elsewhere. Three, they have very high gross margins, and then along with that, extremely high sales growth and profitability, not only projected, but also in the past. So they have very strong historical financials. There's significant opportunity for growth, and there's room for product expansion and extremely broad kind of like customer expansion. So you're not creating like a niche product for a small customer base, but really something that there's a large market for. And then lastly, there's significant room to expand across different channels, right? So if you're currently direct to consumer, there's significant room to become more of an omni-channel business. And those are kind of the key criteria that we think really get those high revenue and EBITDA multiples. A lot of the time when you're in more of the growth stage of the business, or when money's getting invested into the business versus money going to the shareholders' pockets, investors are more willing to put higher valuations because they're kind of putting money into a business that they're also benefiting from the growth of. That being said, the valuation isn't the most important thing. It's really also really important to understand the terms that come along with the valuation. So just because you get a really high valuation, you're valued as, at $1 billion, but based on the terms, there might be a lot of liquidation. There might be a 2 or 3 times liquidation preference, meaning an investor has to see 2 to 3 times their money before any of the other shareholders get anything. I've seen instances in which, the first transaction, which didn't provide the shareholders much liquidity, was the only money that the shareholders received because the terms of a transaction were so egregious. So really important to focus not only on the valuation, but also on the terms. And then, we kind of discussed the venture capital versus PE and strategic valuations. And then lastly, the question that I was kind of alluding to before, but my friend's business received an extremely high valuation. How did that happen? And again, it's really important to understand that the valuation is only part of it. Sometimes it's a special situation. Sometimes it's really the terms that are dictating the valuation and not the valuation itself, meaning there's a very high valuation, but the terms are really what the investor is focusing on. And sometimes you just won't know. But I think it's most important not to compare your business with your friend's business, especially if they're across different sectors, and really just focus on growing your business. So that takes us to the next slide, which is, how do I prepare? So the most important thing first is to really keep your head down, avoid the cocktail party chatter that I was talking about before, and run your business. Really build your brand, know what makes your business unique, and continue to capitalize on it. Part of that is showing proof of concept beyond just your hero products. So it's important to really have kind of generate a cult following from your hero products, but then also show that customers give you the license to expand your product categories, increase your SKU count, and that they're going to continue to purchase new products from you over the years. It's really important to engage with customers and build a loyal following, especially in today's world where engaging with customers online and social media is so important. It's really important to establish that kind of like emotional connection with consumers so that they feel compelled to continue purchasing products from you over time. To scale profitably, or at least scale knowing when you will become profitable, and organize and maintain your data. So this means really getting adequate financials, making sure all your trademarks are in order, understanding your supply chain and inventory, And, if you have an increase in your cost of goods, understanding why that's going to be the case. Do you need to increase prices because of that? Do you need to renegotiate terms or find a new supplier? All of those things are super important. And lastly, your customer data, right? So understanding how your customers are interacting with your business. You can analyze the data on Shopify, Google Analytics. Really important to look at cohort data and understand like how your repeat customers are behaving. So are they coming back and purchasing more? Are they coming back, meaning like their average order values are higher? Are they coming back and purchasing less? Do they often come back and buy gifts? All these things to really understand kind of your customer journey will help you really prepare adequate marketing strategies. And then it's really important to also build your team, right? At the beginning of your business, naturally, you'll be wearing a lot of hats. But as one of the big things that investor is looking to is that when you run your business and when they invest, they want to know that you're not the only person there who knows what's going on. So really having like a core team of people who make decisions and who run the business is really important. And here's kind of an illustrated process timeline. This is, very specific to M&A and also, really depends on the business itself. So I don't want to spend too much time on this, but generally, it could take 8 weeks, something could take 10 weeks. If you don't have materials together and you really need to like clean up all your financials and everything, it could take a year and a half. So it really depends, but Sage always tailors the process to whatever a company needs. So that's my presentation. Thank you so much for listening. And now I'll open it up for questions. If you have questions, maybe do you want to type them in the chat?
Yes. Can we have your email contact, telephone?
All my information, you can message me on LinkedIn or my email's on the Sage website.
Okay.
Yeah.
Yeah. I got a questions. My company has a product that is a unique beer bottle. It's fully environmental, but it doesn't go out to the market yet. Is there a possibility to find investors before the product is out to the market? Because getting it out to the market takes a lot of funding.
So there might be investors, there might be investors who would want to help you bring that to the market, but if you kind of need money into the business to do that, then that would probably be like more earlier stage investors like Series A or growth equity or VC, depending on the stage of your business. But in terms of like, will they go and start bringing it to market and calling different companies? Probably not. They would probably invest money into the business and then have you hire a team to do that.
Okay, now how do I approach this kind of investors? There's any way brokers that can help me do it?
Like typically for Sage, we don't typically do investors kind of transactions at that stage, but I think probably you should look and kind of start looking online to see what type of companies that might be similar to yours, what they did and who invested in them. And then that might kind of take you down a good path.
Okay, thanks.
Does anyone else have any questions here for Marissa? While you guys,
I have a question. I'm owner of Nidara Technology. The company is in the market. We are selling sunscreens that provide protection from jellyfish sting in the water. We are selling the product all over the world, include USA, Brazil, Japan. Spain, France. We are in a break-even situation. We are 15, 20 years old. We don't have competitor. We are not looking at the moment for anything, but whether this type of company is of your interest or not. I mean, can you elaborate?
Is this a type of company that we would represent in a transaction?
What I'm trying to say is that at the moment we are not looking for any type of transaction, but and we are doing okay. But we are a global company with very few people. The product is unique. Whether it is something that you can provide us any kind of guideline, or you might find it interest to offer something to us, or should we think about it ahead of it? If you understand what I'm saying, because we are, okay, please.
Yeah, I think I would really have to see kind of the financial profile of the business and know more information before saying one way or the other. And I know we're kind of in a large forum, so I don't want to ask you more kind of private questions about your business, but I can't, based on information I know right now, I can't say, but it seems like you have a cool product for sure.
Thank you. I will send you an email.
Okay.
Great. We're gonna use the last 5 minutes here for any last minute questions, but in the meantime, I'll let Julia, who's actually jumped on, go ahead and introduce herself quickly while you guys create some last minute questions.
Hi, everyone. My name is Julia. I am from Hawke Media. We are based in Los Angeles, but we provide worldwide services, and Hawke Media does end-to-end digital marketing. We've been working with Sage, and we've been working with the Israel Trade Institute for some time now, and we essentially are here to kind of further help this cohort of companies for any sort of marketing needs. We have relationships with PR agencies. We're happy to provide free consultations. So like anyone that's turning to Marissa for anything investment related, we're here to help you with anything marketing related. And we have tons of experience with international companies, especially when they're looking to kind of formulate themselves in the US market. So I'll put my information in the chat as well. And anybody who's interested in kind of further speaking with us for any digital marketing needs, whether it's SEO help, Shopify store builds, anything within that whole realm, we're happy to help. So yeah, let me know if you have any questions, and I look forward to connecting.
Thank you very much, Julia.
Thank you.
Okay,
Awesome.
so can I something for Julia? Julia, I will definitely contact you. Can you send me your email?
Can.
Okay, in the chat, and I will send you an email about my product, and we're trying to get it into the US market. We also have been trying to go to the exhibition of the nightclub and bar exhibition in Los Angeles, in Las Vegas, but we delayed it for 1 year. So I will send you the product and everything, and let me know if you are interested in moving on that.
Okay.
And also for Marissa, are your companies interested of representing something like that product, a special kind of beer, environmental beer bottle?
So we
it's a
really
patent.
focus on branded consumer products. So we're not really the right company to represent more of like a packaging. We will sometimes represent contract manufacturers in the beauty and personal care space, but not really, just kind of more in the supply chain across other industries.
Oh, okay, thanks.
Sure.
Hello, Marissa. May I ask a question? My name is Yusuf Anton.
Hi.
Can you hear me? Yeah.
Yeah.
Hello. I'm a pharmacist and I'm an owner of manufacturing plant for unique cosmeceuticals, medical cosmetics. We are exporting to many countries in the world, to the US just on a few scale. And there is a big interest sometimes from American companies, but we are afraid, or they wouldn't engage with us because we are quite still a small business, although we are existing over 30 years. And the question is if you can help us for strategic partner with whom we could maybe establish a production plant in the US or elsewhere in North America or elsewhere in the world, and maybe to bring our unique products to the US market.
Yeah, again, I would have to understand more of your business and financial profile, but if you want to email me, feel free. We don't really do as much in pharmaceuticals.
It's not pharmacy, actually. It's not pharmacy. It's the product are registered either as cosmetics or as medical devices. It's not medicine.
Understood. Okay, yeah, feel free to email me, and if you could share
Sure.
anything about the size of your business, that would be helpful as well.
Okay, very good. Thank you.
Mhm.
Awesome. Any last minute questions here? Okay, great. And then just as a reminder, we'll have this presentation available in a follow-up email that I'll send to everyone as well. So in case you missed any parts of this, we'll be able to send that to you as well. But yeah, just as a summary, thank you, Marissa, very much for your presentation. It was very enlightening. I definitely learned a lot from my end, and I'm sure everyone here in the audience did as well. And yeah, thank you very much for joining today, and we'll have them follow up if they have any further questions or want to reach out specific to their companies. Yeah, thank you.
Thank you.
Thank
All
you.
right, thank you, everyone.
Thank you.
Thank you very much to Marissa for a very nice presentation.
Bye, everyone. Thank you.